Welcome, welcome. Got a lot on the schedule today. Obviously, the big topic is going to be some people are calling this a war. Depending on how you feel about this, I'm going to sort of walk on eggshells because whenever we talk about politics, there's a risk. But Joel and Colin, let's open it up. Um, Actually, no, let me do this. Let me pull up a graph from an investment standpoint, what happens to markets during conflict, and that can kind of help set the stage. So let me pull this up and let's see here. Okay, so this is from Hartford Funds, and a lot of you probably already know this, but I think it's always important, especially during conflict, and some people would use the word crisis. Good to zoom out on history. So this is from Hartford Funds, and if we look at these documented conflicts, geopolitical conflicts over time, and the impact on long-term equity holdings. Super important to have a longer term view right now because when you're in the middle of it, oh my gosh, I mean, I can't even imagine what a lot of people in this conflict are going through. Um, However, from an investment standpoint, it's always important we have a long-term view. Joel, let me throw the mic over to you, buddy. What are your thoughts on this?
Well, I agree with you, first of all, but I think we also can't be dismissive of the fact that people have emotions, and it's really important to acknowledge that. I've had two people just reach out to me individually saying the same thing. They're not clients of Vatican, so just longtime friends of mine. And they both said the exact same thing, that their advisor's advice was just don't look at your accounts, ignore what's going on, and it'll be okay in the end. I think that's one end of the spectrum. The other end of the spectrum is to over dramatize what's happening. I think somewhere in the middle and having a reasoned, well thought out answer is really the way that we should be addressing this. But we can't dismiss the fact that if you see your account value go up dramatically one day and down dramatically the next, and it's doing that on a consistent basis, no one's immune to that. We have to understand, especially coming from, you young guys have a different perspective. You got a lot longer to ride these things out. Coming from an older, more seasoned perspective, it's a little more unnerving when that happens. So it's important for us to acknowledge that.
Totally agree. And also, I didn't want to skip over the part of I can't even imagine what it's like to be at the actual core or the receiving end of this conflict. I mean, my heart and prayers and thoughts go out to anybody who's involved in this. I think any sort of war is horrible for people who are impacted. I mean, I can't even imagine what that looks like. And now with social media, Colin, you've probably seen this. You can see actual live, or,
Dude.
footage of this from people's
Mhm.
phones. It's absolutely heartbreaking.
Yeah, I have to stay off of it in times like this.
Mhm.
And I appreciate you bringing up the humanitarian side of this, just the human element. The conspiracy lens is, there's a war machine and it's an entire industry and a business behind it, right? I'm not saying we're going to go down that that little rabbit trail on today's episode, but um, if we switch gears to the investment side of things, right? There's always a conflict or some hysteria that we can get upset over. If we just want to stick with wars, right? We could go back to the early days of the Ukraine-Russia war just a couple years ago and how that upset markets, right? Today it's the operation in Iran. It was my understanding that Congress had to declare war, so I don't know exactly what we would call this, but it certainly feels like something more than just a military exercise, military operation. Right? Tomorrow or in the future, it'll be something different, right? There will never be a crisis or a conflict that won't make headlines and get dramatized or politicized or monetized, right? Et cetera, et cetera. Um, that's why having a plan, having an investment philosophy is so important, right? Because again, if it's not war or natural disaster or midterms or an election year or you name it, right? There's always something that is going to be printed that is scary, that is legitimate scary, right? And we remember this when we're talking to our clients, or at least I hope we do. You're not a bag of chemicals. You are not a spreadsheet, right? It would be unhuman to not have any type of reaction or emotion to things that are going on, like this military operation in Iran, right? Of course, you're going to have questions, and of course, it's going to be scary. But that's why, stuff like this, I think, is so important. There's a community feel to what we're doing here today, right? We are all going through this together, and I think when we bring some data to it and we bring other people's experience and yours, my dad's and Wes's expertise to the conversation, right? They've seen a lot, they've been through a lot, and it is easier to look at you at a human level and say, with confidence, how we should navigate times like this, or the ones that have happened in the past, or certainly the ones, whatever flavor they're going to come our way in the future.
Yeah, and to piggyback off of that community word, this is why investing is hard. Right? It's really easy for me to show a graph of, hey, if you invested $10,000 back in 1940 and you got through all the wars and all these other potential downsides, you would have $5.4 million on the other side of it. If it were as easy as that graph, then everybody would have $5.4 million per 10,000 originally invested. I am convinced that the community aspect and the coaching aspect is 100% essential, right? Like doing things that are really difficult in a siloed version of that, almost impossible. Doing it together, what do they say? If you want to go fast, go alone. If you want to go far, go together. I think is absolutely applicable in investing, which is why one of the graphs that you sent me, Colin, I'll share my screen here. This is a JP Morgan report, and I've seen many of these reports over time where the individual investor, just data after data after data will show over X amount of time where the individual investor just produces dramatically less returns. It's not because he or she is dumb. It's because if you're going at it solo, the game is really hard because as the problems come up, they always look just different enough to where you tell yourself, well, this time it's different. This is the thing that breaks the camel, right? AI is the thing that wipes out the entire workforce. Trump is the president that does us all in, like all of these things. And it's not that there are not elements of potential reality to those things, but it's really hard to see the signal through the noise if you're just looking through your own lenses. Colin, what's your take?
Yeah, this is a fantastic chart, at least in my opinion, right? So a 20-year study of asset classes and the returns that each saw over that 20-year period, averaged, annualized, I should say. Again, yeah, Dow Bar does a study each year that they update, that kind of reflects the same thing. Again, it's not, to reiterate what you said, Wes, it's not because our clients or our investors are silly people. It's chasing headlines or running from headlines, whether it's excitement or fear, right? On both ends of the spectrum. We see people go from asset class to asset class because they read an article or they heard something from a family member or a friend at work or whatever it was about why they should be investing in cryptocurrencies or real estate or commodities or you name it, right? And then the other end of the spectrum, something that we led with today, right? Getting out of the market because of a conflict, right? Like a war, or because you don't like the president that was just elected, et cetera, right? So the behavioral component is what is keeping many people from achieving the returns they would otherwise have if they didn't jump based on excitement or fear.
Yeah, I agree. And the crummy part to talk about on this topic is if you go back out through history, um, war has actually and conflict has created opportunities. And I do not mean to say that as an evil capitalist. I say that as an objective um, student of market history, where there's conflict, there's destruction, or there's dysfunction, whatever it is, and then there's solutions brought in to solve for those things. I'm not saying that's right. I'm not saying any of those, but I am saying from an economic perspective, that's oftentimes what happens. Colin, anything to add to that, bud?
Well, I'm actually disappointed I didn't lead with what just brought up, which is just the actual reality of the situation and how we're really not far off from all-time highs, like at all. right? This could have just been a normal dip even without conflict in the Middle East, right? And I think that's really like piercing information when you're talking about this stuff, because if you just went off the headlines, right, you would think at least from a market perspective, the world was ending, right? But we are essentially at all-time highs, again, off just by a couple of points, and that's baked everything into it, right? All of the supply chain issues we had a few years ago, the inflation, right? The political turnover or the current political environment, the conflict in Ukraine and Russia that still hasn't been resolved, right? Now this new conflict in the Middle East. Yeah, all of that baked in, right? The market is still pushing, still pressing towards near all-time highs, right? So, Dave, thanks for level setting that for me, right? Because I even got kind of caught up in this just a minute ago and really probably should have led with like, hey, this is kind of the point, right? That there's always a headline to take advantage of emotional, especially fear, fear-based emotion. But the reality is, even though we've dealt with a lot of volatility this year, you have down days of 1.5%, 2%, up days of 1.5%, et cetera. We're still not far off from accounts being at essential all-time highs. So that's a good way to level set this conversation.
Well, and to piggyback off of that, if you see my screen, what David is referring to is okay, you've got your year to date number essentially, which is like the beginning of the year, and you have this. Well, that's what he's referring to on for the Dow. But then all we have to do, right, and it sounds so simple, but it's hard to do during emotional times, is you just zoom out on the graph and you say, oh, like this is actually just a small little ripple in sort of a randomized period of time. There's nothing special about year to date. There at minimum, what I tell investors is, you know, when you're investing in Walmart, that funny enough, we'll explore that later today, or any of these enormous companies, they are working off of timelines of decades, not days. But minimum, you want to look at a year. What's the 12-month, what do the 12-month numbers look like? But then it's also even more important to recognize, if you can see that graph, of the money that it's really easy to see or feel. That's a better way of saying it. Feel the money that you feel is being lost when really it's just down temporarily. But you also, it's hard to recognize the alternative. So you always want to think, okay, do I want to be an owner, a lender, a spender, or a saver? Primarily, you're going to be all four, right? You're going to own some things, you're going to lend on some things, you're going to spend some money, and you're going to save some money. But we want all of you to be primarily owners, own assets. Now, what you have to do during times of volatility is if you can think of, okay, well, what if my long-term investments are a little volatile right now, become very present to the fact that if you would have invested in something different, there's a very strong probability over time where, let's say if you were in bonds, where you'd have a fraction of the return over here, a fraction. And you have a long distance between the delta of the accounts being down year to date versus where they would have been. I mean, it almost would have been an 80% drop. Just imagine that. But because you don't see that data right in front of you, it's not so obvious. And that's why I like to split it between owner, lender, spender, saver, just like owner and lender. That's an easy framework. The people who make money over the long term to protect their future selves and their families. I mean, tell me if I'm wrong. They're all owners. They own the assets. And yes, when you do that, you own the volatility, the short-term volatility that comes along with it. But when you lend your money, being a bond, right? When you put your money into a savings account or a CD or a corporate bond or a muni bond, treasury, et cetera, there's times and places for that, which we have in basically everybody's accounts. But that is more of your moat money. That's to protect from short-term volatility. That is not going to protect you in the future. Why? Because inflation is just decaying that money every single day. So we need a certain amount of protective capital for the short term, but that same protective capital in the short term will not protect you in the long term. It just won't. That money will basically go to zero because of that pesky thing called inflation. Colin, anything to add to that? But
Yeah, just real quick. I was just having this conversation with someone the other day. that investing is a relative game, right? Again, essentially what you guys just said. There is no getting out of the arena, right? So I hear this all the time. Someone will come meet with me for the first time or second time and say something along the lines like, "Oh, well, I'm not invested right now. I've got all my money out of the market." Right? So I just ask, "Oh, where's it at?" "Oh, it's in a money market or it's in a bond or it's in a CD or, something like that." It's like, "Okay, well, all you've chosen to do is displace the risk, right? Because there is no getting away from risk in investing. Instead of being invested in public companies, you have chosen to invest in the United States dollar, which we know, to Wes's point, is a guaranteed loss over a long enough time horizon, right? So it is relative to the other things I can invest in, right? How should this be performing, or how should I be behaving around this? It is, again, a relative game, not an absolute one, but that's tough for humans, because we don't really like that feeling sometimes that, our capital, our cash has to be invested in something, and there's risk to all of it, right? So we have to, as capital allocators, we have to weigh the risk on both ends of the curve. The risk of this war leading us into economic turmoil in the short term versus if you live to 102 like my great aunt did, right? There's risk in the long run as well, right? So there is no getting away from risk. We've said this 100 times. There's no risk-free path in all of life. Finance and investing is no different, but this is exactly why we want to check in at least on a monthly basis with you guys here and walk through what we're all feeling as human beings when we turn on the news or talk to people that we love, or hang out with, or whatever the deal might be.
Well, and this is a mantra I want to keep on repeating, reminding, and especially our youth, everybody, uh, have the ownership mindset. When you are buying bonds, that's totally okay. But realize you're lending your money to who? To the owners. So then they can go out and buy the assets. When a bank lends somebody money to buy a house, that person over the long run makes out dramatically better than the bank that just gets whatever 4, 5, or 6% interest plus their principal back. The owner gets to keep the house forever. We've got a house in my family that's now been around for I don't know, 40, 50 years. I mean, think about the returns that come from that. Now, also, I don't know that we have much of an option. If we show this graph that Colin sent me earlier, um, and I don't really want to push on any soft tissue here, the government is just not fiscally responsible. I don't know if this is headlines to anybody, but the more graphs I see on this thing, man, it's like how do you dig yourself out of a hole other than owning assets to a government that keeps on signing you up for more and more debt? I mean, last I checked this, every person, I think every adult, I believe it's like has $108,000 worth of debt. That's either per person or per household, something like that. Even if you have no debt on your personal balance sheet, just by osmosis from living in America and being a US citizen.
I don't know how we get out of this fiscally. I mean, again, not breaking news to anybody, but I think to reiterate or continuing to pound the table here, it is own assets or get left behind. And because of what we're looking at right now, right? Inflation, money supply have skyrocketed, and what has our national debt done because of our friendly politicians? Well, they just keep borrowing and spending and borrowing and spending, to the point where now the interest payments on the national debt have eclipsed the defense spending each year, right? So we are now paying more in interest on the national debt than we are for our entire defense budget, right? And that is it, total insanity. I mean, we know you get nothing in return for the interest payment, right? No American, no politician benefits from the interest payments on our debt, right? So there's definitely fiscal troubles we face. I have no idea when, the crossroad where you kind of find yourself at that intersection. Is that, next year? Doesn't feel like it. Is that next decade? Maybe. Is that in, a 65-year-old today? Is that in their retirement? Feels likely, but Again, I have no idea when the crossroads will eventually catch up to us. All I'm, convinced of is we have a self-fulfilling spiral with borrowing, increasing the debt, increasing interest payments on the debt. And because we don't have the money coming to back all of this up, we continue to borrow and just rinse, repeat that process. The only world where I think you can sustain yourself in this type of fiscal situation is to be an owner of assets.
Yeah, there was something, a term that used to be used a handful of years ago called TINA, T-I-N-A. There is no alternative. And it just went out of vogue because now other, acronyms and so on are used. But really, in my view, with retirees who are planning a multi-decade retirement, how in the world do you get through that without owning assets, without ownership being a substantial, like the vast majority of your balance sheet? How on earth can you get through an inflationary period when our government, and honestly all developed world governments, it seems like, are doing the same thing? And honestly, I think the origin is most people are not doing what you guys are doing. Most people are taking a passive approach to their future. And we all know what that, like, leaders know where that ends. If you're going to be in the passenger seat versus the driver's seat, everybody knows where that ends. But unfortunately, a lot of people are willing to sort of like, practice willful blindness here. If we look at the Social Security numbers, this is fascinating. Colin sent this over as well. This is just fascinating. I don't know, where'd my mouse go? Bear with me. Uh-oh. So basically, what the graph I was going to show was the Social Security numbers on, my mouse is stuck in my iPad somehow. I don't even know how that happened. But basically, what Social Security has kept, how many people it's kept out of poverty. Colin, do you happen to remember those numbers? I'll have to look them up and see what's going on
Yeah,
here.
I think it's something like, without Social Security, it's pushing 40% of beneficiaries. Yeah, there you
There
go.
you go.
Yep. So excluding Social Security, almost four people, or I'm sorry, yeah, 4 out of 10 people, 65 or older would be considered, at the poverty line or below, versus inserting Social Security, right? That number reduces to 1 out of 10. Right? So pretty dramatic, pretty wild.
Yeah, and it speaks more to the point of I am not optimistic that we solve this debt issue anytime soon when we're just adding by the bucketful more people who are dependent on the system. So again, I think one of the worst places to be is kind of in like the purgatory area, right? You got to draw a line in the sand, in my view, and decide to be an owner. And if you haven't decided that, I would urge you to decide it very quickly because as that chasm increases, you're going to have the people who are kind of taken care of 100% by the system. And then you're going to have the owners on the other side who are good based off of their own productivity and their own responsibility with their finances and being willing to face the markets head on. And again, I'm not just saying the stock market, I'm saying, private business market, real estate market, and public company markets. But if you land in purgatory, you got one foot on the boat, one foot on the dock, I'm not so optimistic for those people and their financial future. Why? If you look at something like long-term care, it's one of those things, if you don't plan for, right? And you're not 100% broke and you have some assets, you basically have to say, well, I'm going to forfeit all of my assets if I want any sort of standard of care. Like you got to force yourself into being broke. I'd rather have all you guys land on the other side. Yes, paying that bill is a big bill, but we've acquired enough assets to sufficiently hedge that risk. Joel, what's your take?
Yeah, I think it's really important. It's just one of the risks that multiply all the other risks. As in the longer we live, the more prevalent that risk is. I mean, the longer we live, the larger the percentages that we're all going to face some kind of issue of long-term care. I don't think it necessarily has to be a 10 or 15-year stay, but it could be, a 2 or 3 year stay and you get back out of the it could be a rehab situation for a couple of years after a stroke or something, similar. And then you get back out of the long-term care situation, but it's already devastated some assets before you've done that. And if you don't plan around that, it affects the rest of life after that event.
Yeah, 100%. Now, let's switch gears here a little bit. A lot of you have asked about the housing market because either you guys being impacted or a lot of time for our clients, it's their kids or their grandkids. And some really interesting data around this that Colin brought up as well. Let's take a deep dive. Colin, can you help us navigate through this chart, bud?
Yeah, definitely. So the green line, right, is mortgage payments to purchase a home, right? So that big spike that we've seen in the last couple of years is due to interest rates rising, right? So buying the same square footage house costs significantly more because borrowing the capital costs significantly more, right? And then you overlap that with the monthly rent payments in the blue, right? So just average monthly rent payments over the last, decade or so versus mortgage payments of current owners, right? And something has to crack here, right? I don't know what it is. I think the dynamics of the housing market's pretty tricky. You have a lot of people out there with either a paid off home or an interest rate on their mortgage from like pre-2020, where it was anywhere from, I've seen it as low as like two and a quarter. And during that era, maybe as high as three and a quarter, right? Something like that. That's like an overwhelming majority of people that own homes in this country, right? And the incentive for them to replace that situation is very low currently, right? You're either talking about doubling the interest rate or more, right? That you
Yep.
currently have to go finance a new property, or sell your home, which might be attractive at current prices, but then to purchase another home, right? That thought of downsizing in retirement essentially went away. You thought you'd be able to take your big home, downsize into a smaller home, right? And it's just weird dynamics right now with the interest rate market, the current owners of homes and their interest rates, and what it would cost or what it would take to finance a new home today. What I feel confident about is that if we go another 2 or 3 years out on this chart, right? If we revisited this in a couple of years, there would definitely be some sort of correction one way or another, right? I don't have really a strong prediction on what that looks like, but I don't think this trend can continue for too much longer, which is why I think, the chart is well named. We have a frozen housing market right now. You don't have a lot of people willing to get out of their current interest rate if they have a really low one. You have a lot of people with paid off homes that don't really love the options of buying a house at basically all-time high prices and higher interest rates than what we've seen over the past couple of years. And you got people with capital that just don't really love how it looks and how it feels right now, to the point where renting is actually a cheaper option in many cities across the country.
Oh yeah, I mean out here the way it works, Joel, is they're building a ton, at least that I can optically see. But also Irvine Company right now, which I believe is the biggest national apartment complex or real estate owner, I think in the country, I believe. One initiative that I heard their employees say is they are now making apartments that are almost like dorm style. So it's almost meant for a single individual. And they make them higher end, but it's a lot less square footage. I believe that's sort of next on their docket of apartments to roll out. And for all of you who are interested in this subtopic that Colin implied, this is why we tell a lot of our clients be really careful about making your primary residence a fully blown usable tool in your mind for retirement because you might have in these assumptions it's not as liquid as maybe you assumed. There could be these other dynamics that are at play. A primary home, just real estate in general, is not optimized for maximal revenue production. Its value exchange is the shelter it puts over you, which is incredibly valuable. But it's not like if you own even a rental property, you can go and increase the rents by 4x tomorrow. A lot of times there's laws in place that you can't do that. So, and the market might not sustain it versus Apple Computer or Costco or Home Depot can certainly increase their revenues exponentially if they come out with a new product, they innovate, et cetera. I mean, just look at what the iPhone did for Apple. And here we are many years later, and it's still playing out that way.
Mhm.
So just be really careful about how much you earmark in your mind And on your balance sheet, this is why net worth can be such a distortive mechanism if we're including our primary residence towards that number, especially out here in California. It could be pretty toxic of a way of thinking about your retirement assets. All right, let's head into the home stretch here. As we like to do, we like to zoom in on some of the funds that people invest in because when you see your statement or you look at your phone and you see, okay, I own X, Y, and Z fund, we have to crack that open like a Russian nesting doll. It's hard to viscerally understand how many assets you actually own just in one line item on your statement. So, a company that everybody probably knows is Walmart, not so small company. Let's take a deep dive. So, in many of your funds, you own this outstanding company called Walmart. It's been around for decades. Let's go through this quickly and we'll get some commentary on it. So, real quick, it's very important for people to understand. I have this conversation a lot where sometimes they'll say, hey, should I be invested in just American-based companies? And that is a common misperception. Yeah, it might be domiciled in America, but a lot of the companies that you're probably thinking of in your head when you think about large blue cap companies, these are not, there's an argument that they're not American companies, right? To the degree that you think they are. They are getting their revenues from every corner of the planet that has currency to give them in exchange for their goods and services. So if we look at Walmart, operating approximately 10,500 stores and clubs under 46 banners in 19 countries, serving over 250 million customers and members every single week, et cetera. Let's go on and on down the list. They have three core components: Walmart US, Walmart International, and Sam's Club, competitor to Costco. If we look at their percentages of revenue breakdown, Walmart US 68%, International 18%, and Sam's Club 14%. If we look at their 5-year growth, here's our numbers. If we just smooth it out and don't look at it on a daily basis, and then this is one of my favorite charts. So if we look at 2025 revenue, $680 billion, if we look at what that actually means, right? $1.29 million per minute. This is insane. So if we look at long-term dividend growth as well, which all of you know, we are a big fan of dividends per share. We want to see that trend going upward over time. And then in terms of a competitor to Walmart, I don't use Walmart online. I'm sorry, a competitor to Amazon. I don't use Walmart as a competitor to Amazon, but from my understanding, a lot of people do. And a lot of people tell me it's in their neighborhoods even faster than Amazon delivery, depending on obviously if you have a store right around the corner. So this company is incredibly impressive to me, specifically because they've been able to adapt and pivot over time. And the the degree to which this thing is a cash cow is just off the charts, Colin. What's your take?
Dude, $1.86 billion a day of revenue. It's hard to even appreciate that number because it's so large, right? That is absolutely incredible. I believe I read not too long ago, well, probably a few years ago, that they were able to jump into competition with Amazon because they owned their own logistics, like they own their own trucking company. So when you kind of said that, it kind of clicked. It's like, oh, well, you can have these big Walmart distribution centers and essentially any like state or region that has at least enough people there to support it, and then throw in the fact that they have their own logistics, their own shipping. Yeah, I've never tried it out either, Wes. I haven't used it to compare it to Amazon, but it doesn't surprise me that they're the one who was able to compete in that regard after kind of connecting some of these dots.
Yeah, it's an unbelievable business model for many people, especially in America. Just the convenience, the discounts, et cetera.
Yeah,
And you're
and
talking, sorry, Colin, to cut you off.
no, I think I think it's important to remember. Yeah, yeah. So I think you were kind of headed where I was headed, Wes. I think it's important to remember that when we talk about dividends, every time the subject of dividends gets brought up, it always reminds me of Charlie Munger's, yeah, a little ism that he had, a Mungerism, that when you find a simple idea, like take that simple idea and take it seriously.
Mm.
I think people really, when we teach on the mechanics of a dividend, it's always important to remember that it's a function of business. Like it is a function of value creation, right? So when we were looking at the chart of the 5-year revenue growth, and then a couple slides later, right, the dividend trajectory from the company, it's no accident, right, that the dividend is increasing as a product of them growing the business. And I know that might sound super obvious, right? But only obvious when we kind of spell it out. I think when you ask people generally what's a dividend or how it's paid or some kind of generic question like that, they might kind of dance around the actual answer, but the truth is the only way that all of these companies that we looked at, Apple or Coca-Cola or Google in the past, and today Walmart, right? The only reason that they can sustain increasing dividends over time is because they have a playbook with their business that they can scale and continue to increase revenue, therefore increasing profits that they can share with back to, the key term or key word of today's conversation, they can share with the owners, right? So again, I think it's really, really important to remember where that dividend is originated from. What's the genesis of it? Well, it is the product of business, and that's a key distinction when remembering how we get cash flow from the assets we own.
And a multiplier to the economics now of very large companies is the internet, as well as AI, basically increased compute power. If you look at Walmart, I believe it started about 63, 64 years ago, one of those two. Their e-commerce revenue stream, I believe, has increased 20% year over year. I mean that's insane. It almost violates physics to a certain extent. Like the bigger the ship, you would imagine it can't go faster. 20% increase in that business line and probably going to increase from there is unbelievable. Absolutely off the charts unbelievable. Now, because we have our licenses, et cetera, I'm not saying, oh, go out and buy Walmart. This is a business case study of how big these businesses have gotten. And also, honestly, now that AI is in the mix, I mean, Joel and Colin, I don't know if you've seen this, but the capital expenditure required to really adopt AI at the institutional level, you are talking hundreds of millions, if not billions of dollars of CapEx expenditure. Obviously, most small companies, right? All small companies cannot do that. So these larger companies, now the companies that all of us own, have a unique advantage to get to the agility, you need to be able to have the money to spend on that agility. And that's a very rare, like weird opportunity, but that's the reality. So I would not be surprised if the e-commerce sales of Walmart go up even from here.
Yeah, incredible. I was actually going to make that point or a similar one that I think it's an odd time where these massive conglomerates have a big advantage
Yeah.
over their, kind of the slept-on startup competitor. Yeah, you're spot on. And they're certainly the only people with the capital to build their own data centers. And if you're going to be that close to the information and that close to the data and have all of the other overrides on it, well, you're obviously going to reap the benefits of having all of that in-house, right? And AI is only, at least at today's level, AI is only as good as the information it's fed, right? So another advantage that these large companies have is their databases, right? I mean, think about all of the consumer behavior data that Walmart has, right? So when they're trying to optimize their algorithms, right, their compute, well, they get to do it on a data set that a mom and pop shop and you're at your local farmer market does not have the privilege of seeing that insight. So yeah, it is a weird time for competition in these spaces due to what we thought was going to be, and not that it's not. So I don't want to downplay it, but we thought it was going to give like the little guy an edge initially, right? Or at least I did a couple years back. It doesn't seem like that in the short run. We'll see how it plays out. I think we're still so early here that there's a lot to unfold in the AI landscape. But as it stands today, the amount of capital it takes, to your point, Wes, is astronomical, and there's only a handful of companies on Earth that can truly compete in that capacity.
All right, well, guys, thank you. Like we say, investing is a team sport, and it's an honor and a privilege to be with you guys today and serve your families. If you have any questions, just give us a call. As always, if you are upset, just call Colin, and we will go from there. I'll take all the happy calls, and you guys have an amazing day. Reach out to us if you need us. Love you. Bye.
All right. Thanks, everyone.
Thank you.